Hello everyone, the interview is finally done. It took a long time to edit things and to translate it from Croatian to English. Keep in mind some things are lost in translation and some things could be kind of hard to understand because of that, but we did our best. Big Daddy helped me a lot with this kind of stuff and grammar. He is the voice that will be representing my father. I've sent him a transcript and he was reading from it, and that's how this interview was made. It is super hard to translate things from Croatian because some things are lost for sure. Disclaimer, of course, the bank liquidator is my father, and the way I think and the way my brain works is because of his education and his conversations with me through my 24 years since I was born, and we always talked a lot, and that's how I usually get my crazy ideas that you like. He has a huge experience in the banking industry and different types of branches inside of it, and then again construction, and everything you see in the interview or hear or whatever will be next to me on that side here, so you can read some facts that I'm mentioning. Also, things will be posted in the description of the video with links if you want to download some documents, research papers that he's mentioning, or see the charts better and have them somewhere to read them through. So I'll be posting everything down below. If you trust me, the link will be safe. It will be from a Google Doc. Also, just wanted to mention there will be more interviews that are available later on, depending on how you like this one. I have 2 or 3 hours more content with Mr. Liquidator, so if needed, that will be also made into parts 2, 3, or whatever. Also, when it comes to your questions that you have for him, I will be sure to ask him, and if needed, again, we'll make a part 2. Furthermore, he has and I have a lot of different contacts in different industries, and I would like to hear your opinion on whom you want to hear talking, and then I'll try to contact them and get them here to discuss. But hopefully, everything will be on English, and then there is no need for translation, and we can do it in a much better way and easier. Um, Again, big thanks to Big Daddy for his help in everything. Make sure to follow that guy. He's an expert in a lot of different things, and hear him talk on spaces will for sure bring you some additional value and knowledge around the financial market and AMC and everything else. Have fun listening to the interview. Hello, Mr. L. Thank you for accepting the invitation for this interview and for taking your time to answer some of the questions that the ape community has. Ape community is willing to learn a lot of things during this past couple of months or half a year, and we are always seeking for people who have experiences in certain sectors of financial markets and especially banking in this case. And what the ape community would like to know and learn more about is your experience in the banking industry as a liquidator and bankruptcy manager. So, what are the processes that are happening when a bank needs to liquidate some of their assets, and what happens when a bank goes into bankruptcy? I'm going to leave the first question quite open, so feel free to start in any way you want.
The important thing to know before we go into this topic is the difference between a liquidation and a bankruptcy. Bankruptcy means that there's a problem with the bank and that they cannot pay for all of their liabilities, which means that the liabilities are exceeding the bank's current assets. When we talk about bankruptcy, the first step is called pre-bankruptcy assessment to determine if a bank is indeed going bankrupt. That process leads to bankruptcy, and after all things are done, the bank is gone together with all the money they had. End liquidation means the bank or any other company has enough assets to cover all of their liabilities. At the moment the bank or company is not financially liquid, or in a better case scenario, a person that is in business is unsatisfied with his current income and has decided to close down all accounts and the business itself. Basically, they're leaving the industry because they think they'll get much more money from liquidating a company than what they would get from continuing doing business. So if liquidation is possible, that means that the bank or company is able to repay all of their liabilities and at the end, even get some money out of it. You have to know the difference between bankruptcy and liquidation. In the case of your ape community, you're more interested in bankruptcy.
Thank you for the clarification. But why do banks go into bankruptcy, and what are the most common problems that are leading and pushing banks for filing for bankruptcy? And how does that happen in the market right now with all of the regulations and everything set in place by the regulator?
The problems are always the same. They lend their money to the wrong people that are unable to pay their loans. In America, you have mortgage loans, housing bubble happens, and the bank gives individuals $600,000 mortgage. The bubble then pops and their house is now worth $400,000. Now the bank has to foreclose on the house because the homeowner's unable to pay the mortgage, and basically the bank loses $200,000. The problem is always that the bank gave loans to an industry that is in current trouble, as it happened in 2008, and it's probably going to happen again. In 2008, banks gave mortgage loans to individuals and then combined those loans into packages of so-called bonds, which they then sold to hedge funds.
That was the cause for 2008 market crash, and the ape community read a lot about that sort of thing happening then, and we pulled out a lot of information, and we can see certain patterns occurring even today. Do you think that that could be the case in 2021 and the current market situation that we are facing?
I can't be sure because I'm not intimately familiar with the American housing market and economy. But because there's an abnormal amount of money in the financial markets, in my own personal opinion, the entire stock market is overvalued. Everything was fine when the relationship with China was in order. Now, when there are tensions between the US and China, the consequences of that will be felt on the world's economy. It all started with 5G networks that are currently being controlled between the two forces. Then let's remember 2018, when Miss Ming, Huawei's chief financial officer and the daughter of its founder, was arrested in the US for espionage, which was considered an attack on China and its leading tech company. China is returning aggression toward the United States because of those actions and many more. Because all base industries are in China, and there's rarely a product in the world that is not dependent upon the supplies coming from China, both American companies and European companies have transferred their production into China, and they are highly dependent on its ability to supply. According to some of my information, there are currently 5 ports in China that are closed. They are purposefully postponing the delivery, and how long it's going to stay that way, I have no idea. While the rest of the world needs to wait for materials to be delivered, while at the same time facing penalties for not meeting deadlines and not earning revenue. And if that situation continues, I think it's clear where we're all headed. In the last few months, why have we seen a huge increase in the price of iron, plastics, and everything else? Exactly for the reason I mentioned a minute ago.
Thank you for the clarification and the examples that you gave, but we went a bit off topic, and now I have to pull you back towards the banking and bankruptcy and liquidation. I'm sure that people would like to hear more about your opinion regarding world's economy and current events that are happening and how they are connected, but that will be done some other day, and after this thing is done, we could make another interview later on. The next question that I have is, who decides if the bank goes into bankruptcy? Who is the person or the agency that says, okay, this is happening, we are doing it?
The regulator decides who's going into bankruptcy. I can tell you how it works in Europe. For example, you go into a bank and you have $1 million in your account and you ask the bank to give you $100,000. But the bank says they don't have the money and that they're unable to pay you, or in this case, give you your own money. Then you have to request a written confirmation that they are unable to give you your money and take that confirmation to a regulator. where the regulator contacts the bank and sends his own man to the bank to confirm that the bank is unable to pay out its customers. This is why you have overnight loans or repo agreements with the central banks, so the banks are always able to give money to their clients.
My next question is regarding stress tests. Fed is able to give out loans to the banks for 1 day with 0% interest before they are doing the stress test. What is the purpose of doing a stress test if you're the one giving the banks the money so they seem more liquid and they have a better balance sheet and a better grade in the stress test? Also, why would the Fed do a stress test with information that is, if I'm not mistaken, more than 6 months old at the moment? I believe that's the minimum. What is the purpose of that stress test if you are using outdated information and not the current situation on the market?
That is impossible, or at least it should be impossible. There's no reason to do a stress test if they're using outdated information or they're trying to show a better balance sheet than exists.
Unfortunately, the information is true. The Fed really did that, and the apes believe that that is useless information when it comes to how over-leveraged the banks are or what are the risks in banks.
Okay, I'm not 100% sure, but it should not be done like that. But it seems like they're imposing regulations and the stress test on their own terms because they can. But usually the banks have an obligation every 3 months, at least in Europe, to make an assessment of their risks. We discussed the topic before, and it's crucial to understand. If there's an increase in unemployment, people will not be able to repay their loans. And based on the data that you shared with me in March, it showed that around 45% of the population in the US have missed at least one of their mortgage payments. We could see that trend continuing, and that's when we'll see some interesting stress test results if done properly. You also need to understand that the United States has a population of 330 million people, and that increase of 1% is huge. We're already talking about 45. Inflation continues to go up, and it will. I'll repeat myself again. There will be an increase in the price of products and services. The products and services will be sold to customers in less quantities. When you have huge pressure on a certain product or service, in other words, demand, no one would be stupid enough to sell something for $5 when they can sell it for $7 later. And in a way, you control demand because you increase the price, or on the other side, when you have discounts on certain products, people are rushing to buy them. Those are the basic principles of economics. So if the Fed is expecting an increase in inflation, it'll translate into increase in prices and less buying power from consumers.
Then could you give me an explanation if this increase in prices and inflation is also correlated with certain banks removing private loans and even considering removing corporate ones? Does that mean the banks are unable to give out loans and are currently doing bad business? Or is it actually a good thing for a bank and it shows that the bank is in a good financial situation?
The PhD thesis I sent you should be of particular interest to your community. When it comes to loans and situations like this, when a bank gives out a loan, they're required to put aside a certain amount of capital held in reserve for that loan. So if the bank canceled further loans, it could mean that they have millions of dollars on their accounts, but they're not giving out loans because their risks will increase even more and their minimum capital requirements will go under a certain amount required by the regulator. Then the bank needs to wait until a certain number of loans are returned so that their equity does not sink below the required level. It's called risk-weighted assets. So if you have different stages of risk-weighted asset, they're ranked based on the loan that's requested from the bank. So the bank giving out a loan on an apartment or a house needs to put aside a certain amount of money to make sure to protect the risk and still provide money needed to loan to another individual who's buying a car. That is the minimum capital requirement that the bank needs to have in Europe, which is 8%.
Capital requirements currently in the United States are lowered. This is one of the measures that the Fed implemented during this pandemic to ease up the stress that has been put on the economy. Does that mean the banks do not need to put aside money for risk loans? Are they more free to do what they want? What is your explanation? Is this theory correct?
That is correct, but it's also a huge danger to the financial market in the United States. That should never be the case. It's not sustainable. Banks operate on a business model that they have $100, but only one is their own. That's why I would highly suggest that you read the documents that I've sent to you because they will explain this in much more detail than I am currently giving it. And we'll need to have a future discussion when it comes to calculating these kinds of risks. It's important for everyone to understand the basic terminology that I'm using. Poor regulations and capital requirements are what happened in 2008. The regulators then realized that it needed to be changed and they implemented some new rules. European markets and bank regulators are much stricter. If they weren't the case, the banks would go into bankruptcy. They will not lose their own money, but the money of their clients. And now a good company or individual that was saving his or her money at the bank is left on the street, and it's not his fault. The current capital requirement of the Fed is completely wrong, in my opinion, as a banker. They've wanted to pump in as much cash into the financial market to boost the economy and lower the unemployment rate so people have more money and are able to repay the loans. But that's not the natural way of things. When people are repaying loans, they're spending more, and the government would increase tax revenue. This is all outside of banking and financial theories, of course. There are certain situations that require drastic measures to be taken, but they are not sustainable. And if something is operating outside of the boundaries that are already well known in the industry, it cannot last for a long time. Now the only question is if they're capable enough to predict when it's time to remove these extraordinary measures and return things to normal.
What do you think? Did the Fed do a good thing with this or not? What is your personal opinion regarding the rules that they have set during this pandemic, and how can those rules affect the future of the financial market and the United States overall?
In my personal opinion, I'm certain that the Fed and the European Central Bank did not do things in a proper way. Pumping money into a system without backing it with something is never good because I'm telling you, when you're pumping money into a market, it leads to the market becoming unpredictable. And you can see that every government in the world is now taking loans and somehow trying to fix things. The governments are providing bonds, and the billionaires around the world are buying them, and then they're just returning the money back into the system. Certain banks at the moment even have negative interest rates, which means there is a huge demand for assets that have no risk at all when it comes to balance sheets and reports.
What is your opinion about the current balance sheet of the US banks? We got some reports during the past week, and the banks are lowering the amount of money they've placed on special accounts that is being used for riskier loans. So, if they're decreasing the amount of money on those accounts, are they giving out safer loans, or what is happening?
They should not be doing that if the situation in the world has not improved. As we can all obviously see, it's in a critical and unpredictable state.
To my knowledge, the banks are the ones that are doing the risk assessments. They are the ones that are calculating how much money they need to put aside for the loans that they think and consider that have risks. Is it possible that they are somehow manipulating those risk assessments to show better earnings and balance sheets to the public? Because recently we had a quarterly report from the banks and it was presented as good and above expected numbers, but the bank stock are going down already this week and in the last couple of weeks. Is it possible that they are misrepresenting their risks and their profit?
Of course, that's possible, and it very well could be the case. But there are certain regulations in Europe and in the United States when it comes to things like this. In the United States, there's a specific agency that does the risk assessment of the banks and checks the numbers that banks are giving out. That agency came to our country, into our national bank, and educated us on the process of how they're doing things in the United States. So control comes to the bank, and does an evaluation of the bank's book. They see some risks that were not reported and then documented in the report, while also reporting to the chairman of the board for allowing questionable business, which would lead to their termination.
So if the banks are presenting their risks lower than they really are and somehow hiding that in their books, that would increase their earnings and show the banks as more stable. Is that correct?
That's exactly right, because their earnings would increase while showing the bank is doing good business and is giving out loans that are not considered risky, which would present the bank as more stable. It would artificially create better earnings. Each bank has a certain person that's in charge of regulation, placed there by the regulators, and controls the risk assessment. The question is whether he's doing a good job or not, and that's what we cannot know. It's irrelevant when the capital requirements are extremely low. There's no need to control the bank when there's nothing to control. If the capital requirements increase, then the risk assessment should be checked. And that's a bad thing when the capital requirements are at low. It's all connected.
So what you're saying is that the regulations of risk assessments in banks currently are not happening, or if they are, they're not doing a really good job because there isn't any need to do them.
Well, if the data is correct that you presented, that would be the case. In that case, the only thing that's important for banks is to stay liquid, and that's their only concern. When you go to a bank and you ask for your money, they need to be able to give it to you. Every bank loan has risks, but those risks are divided into categories. Typically, Tier 1 capital requirements include common stock, retained earnings, and other types of preferred stock, and those require having at least a 4% capital to risk weighted asset ratio. Institutions with ratios below 4% are considered undercapitalized, and those below 3% are significantly undercapitalized. In our country, the only risk-free asset that's not calculated into risk assessment is the buying of government bonds. If a bank owns government bonds, it's earning interest from those bonds while they're avoiding any type of risk to be calculated onto their balance sheets. The more bonds they have, the amount of risk for that bank is considered lower.
Does that explain the huge amount of reverse repo agreement that we are seeing right now with the Fed and the banks in the United States? The reverse repo is currently around $800 billion.
Banks that buy bonds and securities, like in this case, are usually doing well, and it would mean that the bank is in stable condition and that it has too much cash on hand. If they're canceling private and corporate loans, as is happening in the present market, it means that they're unwilling to take the risks that those loans bring to the table. Banks are preparing for something that is to come in the near future, and they do not want to be exposed. They also know that if they give out loans right now, there's a good chance that that person will lose their job, and then the bank will be the one that will need to cover the loan. Because the inflation rate is currently extremely high, the banks are playing it safe.
How could the banks use those risk assessments and try to cover up some of their liabilities and to cover up that they are overexposed?
Banks are the ones that are doing their own risk assessments, and the rules that are regulating them are flexible, and the banks have lots of room to maneuver around the regulations. They can play around with risks and money put aside to cover them, so they don't have to pay as much taxes this year and save something for next year. Bank losses are an extremely flexible category because banks have a lot of different possibilities on how to present them. While on the other hand, a company that loses will fail and go bankrupt. It's that simple. It's a super complicated topic if you're not directly involved in finance or banking, but if there's any need to give further explanation regarding how to hide liabilities or exposures in banks, I'll lend some additional insight at a later date.
The current bank reports have shown that the banks have earned a lot more money, or at least they have earned more than the estimates given by the analysts for this period. But as I said, the bank stocks are going down currently, and shouldn't they be going up if this is the case and the banks are doing good business?
The first thing that you need to look at is a bank's balance sheet and to whom they're giving out loans to. Are they giving it to people, institutions, or other banks, or someone else? Giving out money to people is the riskiest loan that the bank could make. You need to take a look at their loan portfolio, but the reports that have been published right now are still reports from last year's information, not the current state of the bank. The negative consequences of what's happening this year when it comes to inflation and unemployment we'll see in the next two quarterly reports. They also could be expecting the Fed to increase the capital requirements. Everything in the bank is involved with their capital.
And the final and the last question. Would you care to explain the netting accounts that are being opened from different banks at the moment? We are seeing banks opening multiple netting accounts, which are used to deduct liabilities between two parties. The official definition goes, and I quote, netting is a method of reducing risks in financial contracts by combining or agreeing multiple financial obligations to arrive at a netting obligation amount. Netting is used to reduce settlement, credit, and other financial risks between two or more parties. Quote end. What could be the purpose behind opening so many accounts? Some banks are opening even 13 accounts.
Opening netting accounts allows banks to improve their balance sheet because some liabilities or future income does not affect their current financial situation. So they come to an agreement with the counterparty where they pay a small interest to get that liability immediately removed from their books. Also, some banks are on the verge of not passing the stress test or aware that they will not pass it in the future. They use this method to get rid of liabilities. They sacrifice a certain percentage of their income by doing it.
Okay, the interview is done. I hope that you learned something, that it was interesting. Even though we've tried to keep it as simple as we can, there are some things that are unanswered for sure. So if you have any questions, feel free to send them to me. I will ask Mr. L and then give you a feedback. If there are a lot more questions and there's a lot more interest than expected, I will be doing parts 2 and parts 3 and asking him more questions to explain in further details, but please make those questions as detailed as you can with specific questions regarding specific situations and things that you didn't really understand. Um, let's see how it goes, and thank you. See you next time.